Todd, I want to bring you in here. We had a couple problems here. First, obviously, what we just talked about, growth is concentrated. Even in the tech area, you could say tech's got a, it's a narrow advance. It's all tech. But even in tech, it's a narrow advance. The other problem, of course, is the market is overall trying to price in rate cuts that the Fed doesn't seem to want to provide us any guidance on yet. So where are we here in this whole game? You're paid to watch flows, essentially.
Yeah, of course. I mean, you had a pretty good sugar rush in the fourth quarter of last year, whether you want to call it a catch-up trade or based on the idea of cuts, which there seem to be going away now. I think a lot of stocks are in extended positions. Semis are part of that, right? Yeah. NVIDIA is some 50, 60% above its 200-day average, for example. Now, that can continue, that can persist. Just be mindful of when mean reversion sets in, it can be very painful. I do like the idea, though, of viewing that the last 2 years were one of the more painful times in market history, right? You had the significant correction in 2022. Yeah. A lot of corners are still down significantly from that, especially in the thematic areas. So you still want to, if you're an ETF investor, look at the more cyclical corners opportunistically going forward.
So, Todd, I'm not a technical guy, but the S&P was flirting with like a double top. And then it just broke through and made all-time highs. Yeah. I personally bought more equities after that. So I get the overvaluation. It's crazy in a way. It's very uncomfortable. But technically, we're okay, right?
Yeah, I think so. I look at 2 years of nothing as a great setup for the next, call it, 2 to 3 years, right? In the near term, next 1 to 3 months, there's going to be speed bumps. That's usually what happens. We had it last summer from July to October. But don't lose sight of the big picture that a lot of stocks are now breaking out over those highs from the last 5 years.
So how do you address, again, this is a different way of saying it, but is the overweight a problem? How do you address the overweight in tech, particularly semis and software? We just put up something, I put it up again. The two groups together are 20% of the S&P 500. You throw in hardware as 8%, we got it almost 30%. Of the S&P is software, semiconductors, and hardware. There you go. There's the group for you. Is this a worry, or has this happened before? And in fact, this is the way the world always is in a rally. It is concentrated. It was 50 years ago with the Nifty 50. It was with internet stocks. Should we not be worried?
As you always say, markets are a voting mechanism. The market is now voting on semiconductors as the next big thing within the index, right? A decade ago, semis were 2% of the S&P 500. They're now 9%. They're catching up to software, which is the largest. You go back 20 years ago, it was Cisco and Intel. Right before the financial crisis, you had energy and banks were the top largest weight. They fell out of favor. You will have semis continue to gain market share, but just know at the ETF level, know what the product you're buying is, right? You go into a grocery store, there's 6 kinds of rye bread. There's 6 kinds of semi-ETFs right now, including Jan's. So you got to look at the ingredients. Is it market cap weighted? Is it equally weighted? Is it fundamentally weighted? That's really important now going forward.
I think what's benefited the winners in semiconductors, because it used to be, what you don't want to be is in an industry where everyone's producing a commodity, because then you have no commodity, you have no pricing power. And I think semiconductors, there were a lot of wars. A lot of companies have lost. And so what SMH does is it buys the winners, or has, because of its large cap orientation. And so we're now, like Samsung is DRAM manufacturer, not an SMH. But also, there's not many DRAM.
Why is it not in SMH?
I don't know. I should know, but I don't know.
Should ask the CEO.
It's not.
Wait, that's you. That's the guy you read it. Why is Samsung not?
Because that's not technically the part of the computer, right? That's the chip, right?
Really? No.
No, it's the memory. But anyway, but again, there's only a few winners.
They don't have a wide moat, particularly, right?
They do now, though. That's the point. But they had these big competitive battles over many years, maybe decades. And these are the winners. Yeah. And so, that's the situation.
I just want to go back to this idea, show you how crazy this is. The SMH is market cap weighted, so the bigger name, obviously NVIDIA is the biggest. It's up 10% this year. But you put up your nearest competitor, it's the XSD, which State Street runs, right?
Correct.
This is equal weighted, XSD. I know we can put that up. There's SMH, put up XSD. It's down 7% this year. In fact, it's gone nowhere. It's 0 in the last year. So in theory, these are two look at that, there you go. These are 2 semiconductor ETFs. You say, oh, I want to buy a semiconductor ETF. This goes back to, you better be careful about what you're owning here. And maybe it wasn't obvious a year ago that this was going to happen. That's part of the problem. Like, oh, duh, Bob, shit, of course everybody should go buy, the SMH. But that wasn't obvious a year ago necessarily.
It's all about the due diligence. Now, I think from an ETF level, equating your broader index exposure can make sense at times, right? The S&P or mid cap, small caps. But when you want to make a more concentrated bet, like the semis or even like a biotech, I think that's when you want to know. Right. Maybe I should go to the market cap.
But now, in retrospect, we say, oh, wide moat, therefore it was. Would it have been obvious a year ago amongst everybody?
Not to me. But I would say that it's been this approach has been a long-term winner. I mean, SMH, since we took it over in 2012, is up 12 times.
Yeah.
I mean, that's just crazy. And it's the core, the chips and everything. And it's just getting more so, right? In automotive, in obviously mobile, desktop, servers, there's chips everywhere.
Yeah.
They're in glasses, right? We're talking about glasses.
Well, one of the reasons this show was founded was because this was 7 years ago we started this show. The plethora of ETFs in sectors was confusing. Like, dividend ETFs. There was 20 dividend ETFs and people didn't know. The show was founded, this show, to help people make that choice. Here's a very good example of it really is shocking performance differential. They're both called the semiconductor ETFs. And it's a shocking performance differential.
I think sitting here today, I could argue that it's very unlikely, and that's what this competitive advantage research shows, that you're going to get a small cap that can really compete against NVIDIA. It's just super hard. It has to be the giants competing against each other, and I would keep the bet on that not happening. But I don't know if you disagree.
You keep the bet on market
on this large cap bias.
With certain industries, I think it makes sense to keep going the market cap route, and I think this is a trend why you're seeing these more niche, concentrated type products come out again. Right? Get rid of the excess small cap names and just stick with the 3 to 5 largest, whether it's using derivatives and whatnot.
It's the Cathie Woods thing, make big concentrated bets on a few things here, and you roll with the winners and the losers. I want to broaden this out.
These companies are gushing cash.
Yeah.
That's the difference. This is sort of, you can call it disruptive technology, but their financial profile is insanely different from ARK.
I want to broaden this out a bit. Your ETF base, Jan's is a lot bigger than semiconductors, folks. Van Eck is the 10th largest ETF fund family, I think it is.
Like
I know this and you don't. All right, never mind. Just believe me, trust me. Call me and ask me. But you have 2 big gold miner ETFs here. The traditional gold miner ETF, that's GDX, that owns all the big gold miners. And you have a junior gold miner, which I've always found intriguing, GDXJ, right?
Yep.
I know Matt Bartolini at State Street made a point about this a couple days ago. Gold ETFs have had outflows in the last year, and yet gold hit an all-time high a little while ago. Gold's, up 7-8% or something in the last year. So this is an example, it seems, of investor interest not matching the direction of the markets. Gold price is up. You'd think, heck, people love that, and yet inflows have been down. Can you explain that?
Yeah, easily, because the ETFs are not the only thing happening in the world, right? So the big demand for gold bullion has come from foreign central banks. After the U.S. kind of sanctioned Russia, most of the rest of the world, we may not like it, said, that's great, United States, but we don't want to have our central bank reserves, at risk of political wins in the United States. So there's been huge buying by central banks of gold bullion. U.S. investor, you're right, outflows out of the bullion ETFs, not a lot of interest in the equities and the gold equities.
And the investors are not as interested.
No interest. No interest.
Why? Usually, retail investors see prices going up. It brings some inflows traditionally. Why don't they care?
Well, you've got the NASDAQ 100 up 50% last year.
Yeah.
And now I get 5% on cash.
And does Bitcoin compete? I don't know.
I think it does.
Bitcoin too. So your gold is kind of left in this abyss of where do I put it?
Like old guys, in their basement own gold.
Well, there's also been headaches even for those gold mining companies that really restructured and very great financial situation. Now they have political risk. So in West Africa and even in Panama, it's not just gold mining, but different kinds of resources, major political issues in getting production and profitability out of those countries. So there's now a premium for North America for lower political risk, and Australia, of course.
Yeah, okay.